In your healthcare fund, it has been the best performer right now, right? So, if you had to describe your investing style, how would you look at it?
My first job was with a pharma company. How I got into pharma itself is very interesting. It starts with my grandfather. He was a police inspector in Kolkata. If you have to understand what to do with the stock, you have to first understand what the company does and what the value of that stock is. So I was for 6 months in Brazil, 3 months in Argentina. My journey with pharma started in this fashion. And by end of 2020, left DSP, got a call from InCred, wanted to join InCred because it was a more entrepreneurial role. DSP, obviously, 150-year-old organization, well-established machinery. So InCred, I was employee number 1 in their asset management business. You know, we are all educated in finance. What is the first line you read in a finance book? The value of any asset is the present value of future cash flows.
Can you give me the framework of how you identified something which you knew would do well and it played out how it played out?
So I acknowledge that I am not the smartest. I also acknowledge that I am pretty much the average hardworking guy. But I also believe that I am probably one of the most patient investors.
Hey guys, welcome to another episode with me, Shashank Udupa, on the Connecting the Dots podcast. And today I have Aditya Khemka from InCred Asset Management, and he has one of the best performing healthcare funds in this year, right? And it is one of the top funds right now. And we are going to go deep into the healthcare space. We're going to go deep into the pharma space and what's happening with this whole GLP situation in India. So we're going to crack all of it. It's a super power-packed episode. So stay tuned. And also, I know a lot of you guys who are watching this podcast don't follow the channel. So please subscribe to it so that we can get even better guests for you guys. Hi, Aditya. First of all, thanks a lot for coming on the podcast.
My pleasure.
And I must congratulate you because you have been the best performing PMS of last year.
Thank you.
And this year actually, not last year. And you have a healthcare focused fund.
So
first, sir, I want to ask, what was your journey in the stock market and how did you end up at InCred?
So look, my journey actually didn't begin with the stock market. I think few people know this, but my first job was with a pharma company called Glenmark Pharma.
Okay.
Yeah, and how I got into Glenmark Pharma or how I got into pharma itself is very interesting. It starts with my grandfather. He was a police inspector in Kolkata. He had some savings, okay? And in those days, Kolkata Stock Exchange was the biggest stock exchange of India.
Yes.
So whatever savings he had, he just asked his neighborhood friends, and his neighborhood friends were all stockbrokers. So, someone gave him advice that, whatever savings you have, just invest in IPOs.
Okay.
And you get those share certificates in those days. So you get the share certificate, you lock it up in your tijori and you forget it.
Wow.
That's the advice he got. So what he did was he ended up investing in 12 IPOs and he invested a total of 20,000 rupees in those days. This is 1980s,
Okay.
1990s. So he invested some 20,000 rupees in across 12 IPOs and he locked them up and he forgot it. Now in 2004, when I was just finishing my CFA and I was going for my MBA to MBA Gurgaon, one fine day he called me and he said, just open that safe and see what is there. So I took out the 12 share certificates and he said, look, you're studying some finance, right? So this is something relevant to you. I don't know what this is worth and I don't know what I did.
Oh my God.
This is the advice that I got. So now you tell me what it is worth. So I looked up those 12 share certificates. Out of those 12, 10 companies had stopped trading.
Wow.
So there was a Filament India, Stone India. I still remember the names, PSUs essentially, which are shut now. They're no longer operational. So out of 12 stocks, 10 stocks had gone to zero. They were not trading. Only 2 stocks were trading. They were Divi's and Ranbaxy.
Oh my God.
So the total worth of those 2 shares, Divi's and Ranbaxy, was 6 lakh rupees. This is 2004. And my education at MDA Gurgaon was supposed to cost me between 4 to 4.5 lakh rupees, and I was about to take a loan, which is why my Dadaji called me and he said, look, don't take a loan. If this is worth 6 lakh rupees, you bloody sell it. You get the money and you finance your MBA through this money.
God.
So I owe my education to pharma, if you think of it in that fashion, number one. Number two, even before I sold those stocks, what I did was what I studied in the CFA, that if you have to understand what to do with the stock, you have to first understand what the company does and what the value of that stock is, right? So for that purpose, I went through 10 annual reports of Divi's Labs, 10 annual reports of Ranbaxy Laboratories, and I understood the pharma business. And obviously, I told my Dadaji, keep it. These stocks will do well in future also. But he was like, I don't want to keep it. I want to finance your education through this.
My God.
But the fact that I went through those 10 annual reports made me very conversant with the pharma business. I could understand the business somewhat. And then when I went to do my MBA, the first company on campus in the summer internship was Glenmark Pharma. They shortlisted my CV because this was CFA plus BCom. So I went for the interview and I could talk to them in the terms of pharma because I studied 10 annual reports of Ranbaxy and Divi's. I knew the pharmaceutical terms, the dossiers, the NDAs and whatnot. And they got impressed and they selected me for the summer internship. Now in those days, MDI Gurgaon did not have a 100% placement track record. So they had 97%, 96% placement track record. So they had this policy that if you have a summer internship and if you get a pre-placement offer, you can't sit for the final placement pre-placement round, you have to take up the pre-placement offer.
Okay.
So I did my summer internship in Glenmark because they selected me. Then they gave me a PPO, so I could not sit for the final, round of placements. I had to join Glenmark, although my interest was always in equities. But Glenmark Pharma gave me a PPO, so I said, why not? So I did Glenmark Pharma for 2 years. And in Glenmark, my job was basically as a part of their treasury. I was doing the financial due diligence of their acquisition assets, acquisition targets. So I was for 6 months in Brazil, 3 months in Argentina, doing due diligence of companies which Glenmark eventually acquired. So my journey with pharma started in this fashion. And after I was about to finish my Glenmark stint, or after about 2 years at Glenmark, I was supposed to get married. And the problem that occurred was that I figured that after marriage, if I want to take a 2 BHK on rent, one room for me and my wife, and one room for my parents if they ever visit, or her parents if they ever visit, the cost of that rent was about 24,000 rupees. And my salary at Glenmark was exactly 50,000 rupees a month. So I was like that I can't survive in this salary, or I can't take that flat on rent if I wanted to. And for that reason, for purely money, I shifted my job from Glenmark to a financial services company.
Okay.
Which was Lehman Brothers.
Okay.
And this was January 2008 when I joined Lehman Brothers. And obviously the pay was higher, but I was feeling very happy and satisfied. I had done my work. And, I said, okay, Lehman doesn't have any exposure to, CDS because they said so in their earnings call.
Yeah.
Their stock price was at an all-time high. Well, Merrill Lynch and Goldman Sachs were stocks at all-time lows. So I said, look, this is a gold standard bank. They knew what was wrong and they did not participate.
Oh my God.
So that makes them great. So I will basically join a great company, work for great reasons. And after joining Lehman, I shifted to the US temporarily because they had this program where, you start offshore and if they like you, they bring you onshore. You are on probation while you're onshore. And then if they like you, they make you permanent. So the probation period is 6 months. So while I was at Lehman US, I was tracking American healthcare companies as equity research analyst. And then the Lehman bankruptcy happened. So I was staying basically at a company-sponsored hotel because, I was on probation, so I did not have permanent residence. And I was on a visa which was sponsored by the company because obviously, again, I am probation. Now, the day the company filed bankruptcy, suddenly these two things did not exist.
Yeah.
The visa did not exist because the company did not exist. The hotel did not exist because the card did not exist. So, it was in a short span of time, a lot of things happened, came back to India. Then Nomura acquired Lehman. And Lehman US was acquired by Barclays. The rest of Lehman was acquired by Nomura. So Barclays obviously called me and said, why don't you come back? We are all fresh and new. I said, look, the experience was too horrible for me to come back to you. What I'll do is, if you can help me with a reference, I can probably think of it. So Barclays referred me to Nomura Europe. And I ended up joining their team. I was there for 3 years, tracking European stocks and advising European funds. After 3 years there, decided to come back to India, joined Nomura India, was there for about 2 years, 3 years, same job, looking at Indian equities, advising Indian funds, and then decided to move to the buy side. So the DSP BlackRock Mutual Fund move in 2015. While at DSP, we launched the DSP Healthcare Fund in November 2018. It was in 2020 the best performing mutual fund of India. And by end of 2020, left DSP, got a call from InCred. Wanted to join InCred because it was a more entrepreneurial role. DSP, obviously, 150-year-old organization, well-established machinery. You're a small bolt in the entire machinery, So wanted a more entrepreneurial role. So InCred, I was employee number 1 in their asset management business. So my ID is still IA0001. So gives me a great satisfaction. From there to today, in 5 years, the journey of 2,300 crores in long-only equity AUM. And 5 products, so that's been the entire journey.
So it was quite interesting because you wanted to get a bigger place.
Yes.
And you went all over the world for that.
All over the world for that. And today, I'm happy that I made these moves because each of these moves, when you look in reverse,
hindsight,
you can always connect the dots.
Wow.
But when you're looking forward, you just don't know what the world is doing to you, right? Wow. I mean, when I was at Lehman, I was thinking, why did this had to happen, right?
So you saw Wall Street in 2008.
I did.
How was that experience?
Look, if you've seen those movies, The Wolf of the Wall Street or the Margin Call, something like that, I don't think those movies exaggerate what was happening.
It was really that bad?
Sometimes even worse. It was an era where I think people had lost the reason why they were in the business.
Wow.
So financial services is an enabling business. It's not really in itself a business. It enables to connect the allocators of capital and the providers of capital. That's basically what financial services do. In those days, I think people got lost in their own fantasy of the fact that they're adding great value to the world. They weren't. They were intermediaries.
Yeah.
And I think that madness spread across everything, in the way they lived, in the way they worked, in the way they behaved. So one part of the experience was this behavior that I was noticing. That I would say was absurd to a certain point, and I was obviously overwhelmed because for me that was completely new. I was coming from a corporate background, from a manufacturing company, right, where people are far more humbler, calm, and even laid back. I would say, they're not like do it now, this second, that second. They're not like that. Suddenly to an environment where it's this second, I wanted this yesterday kind of lines. I had never heard this, I wanted this yesterday. This is something I heard after I joined financial services, that this had to be done yesterday. And then the attitude with money, you earn truckloads of it, you spend truckloads of it, you're still left with truckloads somehow. The equation was bizarre. But the good aspect was that the kind of work that they were doing, or the depth in which that business took me. Fortunately, I had a great analyst whom I was working with, great team working with me. So a lot to learn from, those guys as to how to look at stocks, how to prepare stock pitches, or how to analyze certain business models. I think that was the fundamental part of it, was the best part of it. And, I did fall in love with it because it was so enticing to see these businesses which these CEOs could come and talk about for hours on TV. And if you just go to the root of the business, it's just a very commodity, simple, I am there first kind of a business. Where, if you're there first, you're making money. But the moment you aren't alone, you suddenly stop making money because there are 10 other people selling the same product at the same price or lower price. And then you have to cut your prices. So it was an amazing journey in that sense, after what you got to learn and what you get to see. And you can choose what you want to learn, right? I could have learned the behavior, I could have learned the fundamental part. Because I was young, I was thirsty, not rich enough. Thankfully, the behavior was not affordable. Not that I didn't want to behave in that fashion, but it was not affordable to me. For me, the great part was the learning, and I really enjoyed it.
Wow. No, I can't even imagine, man. Being in Wall Street in 2008 when that went on, I think you would have felt like everything's gone. Like, why am I even here? What is going to happen next?
I have seen 50-year-old analysts cry on their desks. You don't see that often. 50-year-old guys who have worked for 30 years, 25 years, because they had 60, 70, 80% of their wealth in Lehman stock. And the stock was certainly worth nothing.
Ouch. Wow. And obviously, you're a fund manager as well. Have you ever once thought about that Divis IPO stock that your grandfather had? Like, what if? I'm sure you would have done some math once.
There's always that math, I mean, look, we live in a market of regrets, right? It is a market of regrets. No matter when you buy, you will have a regret that I didn't buy it earlier. No matter when you sell, you'll have a regret of why I didn't sell it later. So if you just keep going back and regretting, your entire life will be spent in regrets. So to answer your question, have I done the math? The answer is yes. The second part of it, do I regret it? The answer is no. Because the day I start doing that, I can't do my job. So the idea is to try and replicate that success from a future forward basis rather than going back and regretting what you did. That you can never be regretful in this market.
Super. And so you've done that because in your healthcare fund, it has been the best performer right now, right? So if I had to ask your investing approach, yes, you have been in pharma and healthcare for most of your life. But if you had to describe your investing style, how would you look at it?
So look, the usual things are there, right? So you would have your management checks, you will have your business model, competitive advantage. What we do slightly differently, other than what the normal investing books would teach you, we look at we do not look at profit after tax or EBITDA or sales or market share.
Okay.
We are all educated in finance. What is the first line you read in a finance book? The value of any asset is the present value of future cash flows. It's not future profit after tax. It's not future market share. It's not future sales EBITDA. It is cash flows. I think somewhere our edge is that we focus on the cash flows a lot more than we focus on the P&L.
Got it.
So the annual reports, when you read, it's first P&L, then balance sheet, then cash flow.
Correct.
My analyst and me, we go cash flow, balance sheet, and then if at all time is left, P&L. I can completely ignore the P&L if I have to. But I cannot ignore the cash flow at all. Each and every line item in the cash flow has to be understood, has to be analyzed, and has to be focused on. Because end of the day, what your stock does will depend on how much cash it generates, not how much profit it reports. There are companies historically that have reported tons of profit without any cash flow.
True.
Those stocks are no longer listed. Case in point, Mozabab. I don't know if you guys remember, Mozabab used to make those CDs and DVDs.
Yes.
Right? So they're profitable. They were generating cash. But over time, the price of those CDs and DVDs are coming down. And Mozabab was putting incrementally more and more capacity to produce more CDs and DVDs. So they were able to show top line growth because there was more capacity.
There's no cash flow.
But there was no cash flow because they were making less from the existing business. borrowing more to put more capacity in the hope that someday prices will turn around,
Yeah.
which they never did. The product actually went obsolete, and today Mozaber isn't listed.
Wow.
Right? So that's one thing we do very differently. We focus a lot more on cash than we do on profit after tax and EBITDA or any other number in the P&L. The second thing that we do very differently is forensics. Now, when we say forensics, we don't say for the sake of it. What we say, we look at the conversion of the reported EBITDA into cash. We look at the promoter's behavior in terms of his buying and selling of the stock pre-post a good or great announcement or a bad announcement. So promoter's behavior. We look at promoter's stake in the company, whether he has pledged the shares. If he has pledged the shares, he must have taken a loan. What has he used the loan for? Does he have an alternate business, or does he have, the ability to pledge his shares, borrow, and again invest in this business only because he's so bullish on it, so on and so forth. Because he's the most informed guy about the company, so his behavior matters.
Yeah.
Then I look at his minority alignment in the sense that, so let's say the company law allows these promoters to take about 10% of the PBTS salary, right? Now, I have examples of companies for you, which obviously I'm not going to name, but I have examples for you where they first see how much PBT the company is going to report, and then they reverse calculate 10% of the PBT as their salary.
Got it.
And that number can jump from, let's say, 2 crores to 20 crores because the profit went 10x, their salary will go 10x.
10x.
Right? And then I can give you examples of promoters who take 1 rupee per annum salary while the company reports 4,000-5,000 crores of PAT or 4,000-5,000 crores of cash flow. And the promoter takes 1 rupee salary because he has enough wealth and he doesn't really care about the wealth.
Yeah.
So then the latter promoter is better for us and the former promoter, obviously, we don't like. And so on and so forth. So there are many, many things where, we differ from how, or rather we do these things more compared to what the book teaches us.
Interesting.
And that helps us to identify certain opportunities sometimes, which may not be so evident to everyone. And that I think helps us a lot.
So coming to the cash flow, I had also read somewhere there was a thing in US where they had done the study of multi-baggers in US where they had come out with this thing called FCF to yield, FCF yield ratio, where most of the multi-baggers always had a 3 to 4% above FCF yield. Now coming to Indian context with, let's say, pharma, and they're all capex heavy businesses, whether it's pharma or healthcare, hospitals, whatever. So cash flow usually gets affected at a point where there is self-sustained growth rate and there is aggressive growth rate. How do you manage that?
So we're getting a little technical here, but let us get technical. At any point in time, if you want to evaluate a business, you can only evaluate it when the growth rate is the steady state growth rate. That's the term you use, steady state. For instance, a healthcare stock. If Indian economy steady state growth can be, let's say, 7%. This is nominal.
Yes.
Which means real would be let's say 2-3%. Right? If Indian economy, let's say 7% nominal steady state growth, then any healthcare stock, when they reach 7% cash flow growth, that's when they are more or less in steady state.
Yes.
Now, today, most of these healthcare companies, if you look at their cash flow growth, it is 25-30% or 20%. So they are definitely not in steady state. They are in a high growth phase.
Correct.
Which will lead to the steady state at some point, which can be a decade, 2 decades down the road, but they will reach there in some time. So when you're looking at a high growth phase, you cannot look at FCF because to achieve the higher growth, you have to keep doing capex.
Exactly.
So hence what you look at operating cash flow.
Beautiful.
And you don't look at free cash flow, you ignore the capex for now.
Okay.
It's when the company reaches steady state, that's when you calculate FCF. So that's what you do today, for instance, in IT companies. Because they are mature businesses and they anyways don't have capex in IT. But let's say if you were looking at a consumer company, FMCG, again, they don't have much capex. So consumer and IT are probably two markets in our economy which have reached broadly the maturity stage.
Yeah.
Right? And hence, in these stocks, you can look at FCF and talk about FCF. But the other segments, where including healthcare, there is so much growth available, there is so much penetration available that you cannot be talking about a steady state there yet.
Correct.
Let me give you an example. Let's take hospitals. So in India today, given the number of hospital beds we have about 0.8 hospital beds per 1,000 population. You know what the global average is? It is 2.7.
Wow.
And we are at 0.8. You know what the developed markets like South Korea and Japan are at? 12 to 13 beds per 1,000 population. We are at 0.8.
Wow.
Global average 2.7 is basically dragged down by the underdeveloped economies of, let's say, Northern Africa, Latin America. They're dragged down the global average. But if you look at the developing to developed economies, they're closer to like 8-7 beds per 1,000 population, and we're at 0.8.
Yeah.
What does that mean? That means that even tomorrow, if all the hospital chains in India, including government hospitals, which are a very large chunk, they all 10x their capacity, then will come in line with the emerging and developed economy. So we have a 10x scope.
Yeah.
So if you're looking at a 10x scope, you can't be talking about capex. Then the next question which many investors ask me, including people like you, They ask me, then why aren't these hospitals, increasing capacity more aggressively?
Correct.
The answer is talent. The problem is talent. So these hospitals are not raising money to do capex. They are not. None of them have. These hospitals are basically constrained by the availability of doctors and nurses.
Interesting.
In our country, medical education by and large is in the hands of the government. Because it's hand of the government, there is some level of, corruption or inefficiencies in there. And these doctors, when they graduate, the money that they are able to make here, it doesn't justify what they have basically shelved out for their
True.
education. So they get lured by these higher salaries that they make, abroad, be it Dubai, be it Singapore, be it London. So they just migrate after studying here. And I would say it's an individual level thought at the doctor's level, but it is also the government's fault for probably not privatizing medical education. You should privatize medical education and you should create more doctors. The demand is huge, but we are not just doing that. And bigger than doctors, the issue is with nurses.
Yeah.
We don't have enough nurses in our country. So you can't create a hospital unless you have the required amount of hospitals and doctors and nurses. So to cut the point short, we look at OCF because it is a growth sector. So FCF can't be looked at really. And there will come a steady state. We'll start looking at FCF, but that's probably 2 decades, 3 decades down the road.
Beautiful. I think you summed it up wonderfully well. And I never thought about the doctor shortage, which is a true point, because I myself have few people in my family members who have completed this and they've gone to London and, as you said, doing some program there and not planning to come back.
Makes sense for them. They earn 5x the money with the same labor.
Correct.
Why not?
Wow. And do you have a checklist? I don't want the normal checklist because you said most of it is pretty basic, but can you give me 3 checklists that you look at when you evaluate a good stock?
Sure. So one we look at is the growth of the company in the, let's say, past decade. So one, how secular is the growth, or is it lumpy? If it's lumpy, why? If it's secular, why?
Okay.
I have to ask both questions. Okay. So for example, if I were to stand today and look at the last 10-year growth, hospitals will probably be the most secularly growing bucket. And you will see a lot of lumpiness in pharmaceutical companies earnings. So let's say Lupin or a Sun Pharma, for instance, last 10 years, you will see their revenue jumping 60% in 1 year and then next year falling 30%, right? That's a lot of lumpiness in top line. So then we ask questions. So I can understand why a hospital will grow like this because they have the beds, occupancy improves gradually. So they grow like this in a linear fashion. I get that. But why would a pharma company have that? Right? Pharma company should ideally follow the same pattern as a hospital.
Correct.
But that is because the business model is different. So hospital is providing services only in India. This pharma company is also exporting to the US and Western Europe. Now, when they do that, there are product-specific opportunities that emerge. But these are short-lived opportunities. So they do encash from that opportunities. But that opportunity, once it expires, they do not always have a follow-up opportunity to cover up for the revenue of the lost opportunity. And hence the lumpiness comes, and hence those stock prices seem very, very, very cyclical to you.
Yeah.
Would you venture a guess what the 10-year stock price CAGR for Lupin is today?
12?
12%?
Yeah. 10
Similar
years.
guess for you? 12? 24%? It is -1.
-1 in...
-1. 10-year back, Lupin stock price was 2100. Today it is 1900.
Wow.
Now that's because they had some lumpy opportunities 2015, which hasn't yet occurred till 2025. They haven't been able to replace that.
That's also, do you also think it's become very competitive, the pharma space, with the number of products and people fighting for it?
So look, that's again a very interesting question. So that's again, we are slightly different in how the conventional thinking is. So let's take 2 markets, the American market and the Indian market, the United States of America and the Indian market. Now, the Indian market, you would at this point have about 6,000 to 7,000 pharma companies operating, right? And this is the most profitable business for across pharma companies. The US market would have between 600 and 700 pharma companies.
Okay.
And this is the least profitable. If competition determines profitability, then this is a paradox.
Correct.
Right? Now, why that exists, right? So answer one, why is the US market less profitable? Let's talk about that. So let's say there's a patient in US, he has fever. He goes to the doctor and the doctor gives him a prescription saying paracetamol. Now the patient goes to the pharmacy, says, give me paracetamol. The pharmacist will tell him, I have paracetamol of Sun, Cipla, Lupin, Reddy, Biocon. Which one do you want? What will the patient say? Give me whatever is cheapest. I don't care who's manufactured, no? Right? So when a product is sold purely on the price of the product, what is it? It's a commodity. Now in any commodity product, if the supply exceeds demand, regardless of the number of players, forget the number of players, regardless of the number of players, if the just supply is more than the demand, nobody's going to make money. There will be a price war.
Correct.
And in the same commodity, if demand exceeds supply, everybody makes money. Again, doesn't matter number of players. Whatever is the capacity, they will make money. Now, unfortunately, in the US market for the past decade, demand has been less than supply. The supply is outstripped demand. And hence a stock like Lupin still has not achieve the price that was there 10 years back. Sun Pharma is barely 30-40% up in last 10 years.
Yeah.
Point to point, not CAGR, point to point, 30-40% returns. And that is because the largest bet, which is the American market, is just structurally broken. The demand is falling very short of supply. And hence nobody's making money. So this market, despite being less competitive, as in less number of players, 600 to 700 players, is not profitable for anyone because supply is exceeding demand.
Interesting.
Right? Now India, here there are 7,000 companies, right? And US, by the way, is a $600 billion market. India is about a $40 billion market, right? So the size of the markets
Crazy.
aside, right? Now come to India. Let's take the same patient. He has fever, goes to the doctor. What does the doctor write on the prescription?
With the brand.
Dolo. What do you guys take at home when
Dolo.
you get Dolo? You take Dolo. Can you give me a price of a strip of Dolo?
No idea.
Good guess.
Yeah.
But the fact is that you don't care about the price. If it was 40, you'll still be buying it. If it was 30, you'll still be buying it.
Yeah.
That's the business I want to invest in, Shashank,
Yeah.
where the consumer doesn't care about the price. Why do you not know the price? Because it's not important. The price is not important. The fact that
doctors-
it's Dolo
Yeah.
is more important than whether it's available for 30 or 40 or 80.
Yeah.
That doesn't matter. That's the business as an investor you should like, right?
Yeah. It's a very cultural thing, right? Because I don't want to go against the doctor.
Yeah, exactly.
I feel something will go wrong if I.
It's cultural. Maybe more importantly, I think the reason is that in the US, you have a US FDA, which ensures the quality of every product that is available on the shelf. In India, that just not is the case.
Yeah,
right?
you don't trust it.
You don't trust. And we have heard cases in the past, abhi cough syrup ka ek case aaya,
Correct.
right, where some patients died by consuming the syrup. So here the brand stands for the quality.
Correct.
Because our regulations are probably not strict enough. Here the brand stands for the quality. And hence the doctors goes after the brand.
Interesting.
Because end of the day, what is the doctor's incentive? See, doctors can't advertise themselves. Correct? So how does the doctor ensure more footfall? If his patients that are coming to him, if they get well, they will spread the word that I went to this doctor, he is good, I got well, and hence you should go to him. So doctor ka incentive kya hai? That you go well, you get well if you are a patient. And if his incentive is that, then he's not going to prescribe a medicine to you which he doesn't know is the right quality or not. And the brand basically stands for the quality. That is why he's prescribing you a brand.
Wonderful.
Now, in India, the business is more profitable because I am able to charge the price which I feel is right. Because I know the consumer doesn't care about the price. So my pricing is better, my margins are higher, and because I have the ability to price, I don't have to manufacture. I give it to a third party to manufacture, an approved quality third party, but I give it to a third party. So not only am I high margin, I'm also asset light. This dovetails into me being high ROE.
Yeah.
In the US, because I have to keep my price low, I have to keep my cost low.
Yeah.
Because I have to keep my cost low, I'm not outsourcing anything. I'm doing everything in-house. So my asset base is higher and my margins are thin because demand is less than supply. So my margins are thin and my asset base is higher. So my ROE is destroyed.
Yeah. Wow.
And here my ROE is substantial. It is only in the pharma business in listed stocks in India. You see companies that are 5-6x revenue of another company have ROE of 12-13%. And the company which is lesser revenue, they have ROE of 27-28%. Generally, we would argue that scale means higher ROE. Not true, because here in scale, you are doing a business which is the American business, which is low ROE. Here without scale, you are doing a business which is the Indian business, which is excellent ROE.
Crazy.
So that is not the case in other sectors, which is why this sector is so unique.
Yeah.
And our view on the sector is very different. It's unique because we know the modalities that go into these businesses.
Every time I think I know a little bit of pharma, I realize I don't know anything after a point.
It's a it's a different sector to look at.
Yeah.
It's not like banking or metals.
Wow.
It's very difficult.
I have one more question, which I think a lot of people are talking about, which is this GLP thing that is coming into India. When I was in US, I saw ads on TV of Ozempic, and it was very normal.
Yeah.
You take it,
they
become healthy and all
They
of
do.
that. In India, it's coming now, but a lot of talk is there and people have gone very deep into the value chain.
Yes, they
What is your take on this?
So two things. Number one, the reason why you are able to see ads in the US is because they allow pharmaceutical companies to advertise their products.
Yeah.
In India, that is not allowed. In India, because people don't self-prescribe drugs, the government doesn't want people self-prescribing drugs. So they don't allow the pharma companies to advertise.
Got it.
So here your doctor is your agent, you can't go and buy a drug on your own. So that's the reason why you saw advertisements there. As far as the drug goes, it is supposed to be a diabetic drug.
Yes.
It is for diabetics. One of the side effects of the drug is weight loss. Now this is called an off-label promotion, which is again in US broadly allowed. In India, strictly speaking, illegal. But who's enforcing? So let people take it to get slim. I am by no measure fit. I have never touched a GLP-1 drug. I'm not going to touch it.
Yeah.
Why? Understand why the label says it's a diabetic product, because it has impacts for your pancreas and your kidneys, which a diabetic doesn't mind, given that he has a much larger threat to his health. He is okay to take that impact on his kidney, pancreas. For us healthy individuals, at least healthy in the sense that we don't have diabetic, we're not diabetic, it doesn't make sense for us to take that impact.
Yeah.
And just because we don't want to go to the gym or eat less or eat healthier, to take a drug which anyways tinkers with your pancreas and kidney, it just doesn't make sense to me mentally. So that's on the drug part. Now coming to the value chain, yes, I mean, many people are consuming it, celebrities and all. They are taking it. They are fascinated by the fact that they are losing weight fast. I just hope and pray that, their health doesn't get adversely impacted because of the potential impacts of the drug. In terms of the value chain, again in India, I think too many players chasing single opportunity.
Yeah.
Too many people talking about it. So I met a couple of pharma companies that are not a part of the GLP-1 value chain. And you can obviously say angur khatte hain types, but I asked them, why aren't you? They said, where's the space?
Everyone's in it.
Everyone's in it. And even if I enter, I end up getting like 0.5% market share or 1% market share. I would rather do something else and make more money there than, focus here. And my experience in this industry tells me that when any opportunity is so large and so many people are jumping on it, barring one or two guys who may have a first mover advantage, nobody will make money.
Is there any shovels wala theory in this? Sell shovels in the gold rush kind of a thing? It's like the AI.
Kind of. It's kind of like that. But in this, again, there will be a couple of winners. There will be a couple of guys who will be the, first movers, and they'll have that advantage of that brand that gets built. Right. So for instance, in paracetamol, you would today have in India 600 brands, 700 brands. But it's Dolo, Crocin and Calpol. That's correct. I mean, these three guys are the 80% of the market. So similar thing will happen in GLP-1. So you will have like 600, 800 brands, but 1 or 2 or 3 guys will be like controlling 70-80% of the market. And to identify those 3 guys today is very difficult.
Very difficult.
So which is why my error rate here is going to be higher. Right? So, and I am an investor. My focus is to make lesser mistakes. The winners will come. As long as I can avoid the mistakes, I'll have the winners. But I can't afford to have mistakes in the portfolio. That's the way we approach investing.
Yeah.
So in GLP-1, if I go and take 10 calls today, maybe I'll get 2 right, 3 right, but I'll get 7, 8 wrong.
So do you wait for the maturity to happen or some?
Absolutely, I can. That's an optionality, no? So this, again, this is a technique which has been ingrained in our brains. It is now or never.
Yeah, I want to ask this because retail audience has been
Things
talking
like
a lot about GLP.
Correct.
And every stock is a GLP stock today in pharma, right?
Almost.
So do you think that people are wrong here, or they're trying to jump 15 guns at the same time?
Look, I wouldn't be as arrogant to say that people are wrong here. What I would say here is that for me, the chances of making error in this will be significantly higher.
Correct.
Than the chances of getting it right.
Beautiful.
So I would rather avoid it. I would wait for a year or two. Let the winners emerge. If it is such a huge opportunity and if it is going to last for 3, 4, 5 decades, what is the hurry? That I might lose the initial 20, 30, 50% jump in a stock? Fine. You can't win every battle. And you should not fight every battle. And there are certain things that we let slide. I mean, the focus again is to not lose capital.
Yeah.
That's obviously priority 1. Priority 2 is to see if we can make money on the capital that we have taken. But priority 1 is not to lose it.
Yeah.
So in GLP-1, I think a lot of people will end up losing money.
Yeah.
And a few people who are able to guess right or are able to go deeper and take a better educated guess will probably make money.
Beautiful. So I think I can just sit here and keep listening to you all day. The maturity is insane.
Please.
Okay, so I want to talk about now some winners and losers of the past, because I know everyone has some winners and losers.
Absolutely.
So how did you, obviously you don't know what a winner is, you will come to know later, but can you give me the framework of how you identified something which you knew would do well and it played out how it played out?
So I think one thing which again is slightly different in my thought process. So I acknowledge that I am not the smartest. I also acknowledge that I am pretty much the average hardworking guy. But I also believe that I am probably one of the most patient investors of capital. Now, when I say most patient, what edge does that give me? It gives me the edge of buying a stock today, which others are selling today, because the next 2 quarters, 4 quarters, 6 quarters are not good. And for maybe a transient reason. Not for structural causes, but for transient causes. Case in point, let's say a winner of the past, Ipca Laboratories. So Ipca Laboratories, and Ipca has gone through a stock split after that. So the numbers that I'm going to tell you is going to be pre-split.
Okay.
Right? But just let's, for numbers sake. So Ipca in 2014, July 2014, had a US FDA problem. Now, the depth of our research told us that IPCA's EPS at that time was 42 rupees.
Yeah.
Of this 42 rupee EPS, the stock price was around 900. Of this 42 rupees, about 35 rupee EPS came from the domestic business, which has nothing to do with the US. And there was a 7 rupee EPS coming from US and allied marketplaces. Now the issue came. Now when the US FDA issue comes or any compliance issue comes, what happens is step one, you lose your revenue. So obviously your profit goes away. But because you lose your revenue, it's not just the profit that goes away, your costs actually go up because now you have to make changes for compliance reasons. So your operating costs go up and your revenue goes away. So something which was making 7 rupees profit for you suddenly starts making 12 rupees loss for you.
Wow. Okay.
So IPCA's EPS from 42 went to 9 rupees.
9 rupees.
9. The stock plummeted from 900 to 400.
Okay.
Now at that $400 level, with the EPS of 9 rupees, across the board, people were selling IPCA because it was 37 times, 38 times.
Still high compared.
Still so high. At that time, the other pharma stocks would have been 30 times, right? And this guy was like 40 times plus, 9 rupee EPS and 400 rupee stock price. And we did our math. We said, look, let's not look at the 9 rupee profit. Let's look at the sum of the parts. So the India business is still 32 rupees profit because US FDA doesn't impact India. So that's 32. So which implies that they're making a 23 rupee loss in the balance business, which is why the 9 rupee profit is coming. Now, if it is 42, if it is 32 and 23, and we know the IPCA promoters, and we know they are very judicious people, they are Marwadis, and they are very, very conscious on their capital allocation. So there were only two things that were possible to happen. Either this minus 23 goes to zero and then a profit, which is why they would run the business. And if this minus 23 persists, they will close the business. Now, why should you make a loss? You don't run a business to make a loss.
Yeah.
Right? So this minus 23 was clearly not sustainable. So we said, okay, so if this minus 23 is not sustainable, let me talk about the profit that is sustainable, which is 32 rupees. So if the profit is 32 rupees and not really 9 rupees, as you can see on the P&L, and the stock price is 400 rupees, then while the other pharma stocks are available at 30 times, this guy is available at 13 times.
Yeah.
It's a buy.
Plus there's a growth of the 35
that 32 will grow in future as well. While this 23 loss might go anywhere, but eventually either it will go to zero because the business will be shut down, or it will become profitable because they will turn around the business. Now here is the catch. So we bought IPCA at 400 rupees in around July 14 this happened, maybe August or September 14, we started buying IPCA at this 400 rupee price. That 400 rupee price then went to 300 because obviously EPS is 9 rupees.
Yeah.
So it's 30 times now, suddenly 33 times. Obviously your patients get tested.
Good drawdown also.
Yeah, good drawdown, 25% drawdown. Your bosses, your colleagues start to look at you in a funny way. Kya dila diya? Kya socha tha? Where is your analysis? And you're time and again visiting the same and educating the same thing, right? Look, this profit, this loss, this can't sustain, this will sustain. So my life in those days was repeating this math in my sleep because I had repeated it so many times to my clients and my bosses and my colleagues that I was not able to forget the math ever. And that is why I still remember the math. This is, if you think about it, 12 years old, right? And I told them, wait, it will happen. So from 2014 to 2016, the stock went from 400 to 300, back to 350, back to 300, and then back to 400. So after 2 years of holding the stock, we are at 400. And these 2 years, I did not have any decent appraisal. Because because what the hell, right? So what did you get us into, right? So and then finally this IPCA guys decided enough is enough.
Yeah.
They did not get the business to be profitable. They just reduced their costs on the business. They said we'll not do anything more unless we get an approval.
Nice. So that 23 became much better.
That 23 became -2.
Wow.
So that 9 rupee EPS suddenly looked like 46 rupees.
Oh, it's re-rating time.
So that IPCA 400 rupee stock, like for like today, is 3600.
Wow.
So that's the money we made, right? And that taught me what did I do right and what did I do wrong. So I learned 2-3 lessons. One, if you have patience, you can buy these stocks at these kind of throwaway prices and everybody would still be selling it. So you'll not be able to get the bottom, right? Everybody will still be selling it and they'll be calling you nuts. And you should have the thick skin to just focus on the math, focus on what you're looking at, keep revisiting your work, not fall into love with your call.
Yeah.
But don't get romantic about it is what I'm saying, right? And just keep revisiting your math, keep sort of tracking if the company is doing what you think they're supposed to do in this situation. And if all those dots are getting ticked, all those boxes are getting ticked, then you stick with your conviction. Then you don't budge.
Got it.
Not just because others don't think the way you are thinking. And you will make money.
Yeah.
So that's one, so obviously we made tons of money on IPCA after that. The other recent winner I want to talk about is, let's say, Healthcare Global,
HCG.
HCG. 2020 COVID time, HCG, oncology super specialty hospital chain. Just sheer bad luck before COVID, they had taken tons of debt and they had expanded to newer facilities. Now in hospital business, when you start a new facility, the first 2 years, the facility will give you losses because you have to have the nursing, the doctors, the AC, everything from
Full
day
staff.
day one. And patient footfall takes time to ramp up. Network, referral network takes time to ramp up. The first 2 losses, they're supposed to give losses, right? First 2 years. In the meanwhile, COVID struck. Now, because of COVID, a cancer patient is the most immunocompromised patient on earth because he's taking chemo. His drugs basically break down his immunity wall so that the chemo kind of drugs can work on his body. See, your immunity system is designed to resist anything foreign or anything alien. The drugs, the pills, the chemo that you take, these are alien substances. So your body is designed to stop these things from working inside your body, right? So you have to take drugs which first break down your immunity wall so that these drugs can enter your system and work.
Correct.
So hence a cancer patient is very immunocompromised. And in COVID time, obviously a immunocompromised guy cannot venture out because if he catches the virus, he's dead.
Yeah.
There's no drugs that he can take to prevent him from dying. What we saw was that HCG IPO'd at 350 rupees. They had done great expansion and then COVID hit. And then there is no footfall, there is no business. Suddenly solve losses, right? P&L losses. In the cash flow statement, somehow the cash flow is positive.
Okay, how?
And how is the cash flow positive? Somewhat little drugs they are able to sell to their patients at their home. Or somewhat little treatment they are able to do for new cancer patients. That is keeping the cash flow still positive. They are not burning cash. Same was IPCA. In 2014, IPCA's PAT had fallen from 42 to 9 rupees. But the cash flow was still very positive. They had not gone into negative cash. Same HCG did not go into negative
Even
cash.
at low volume, they were...
They were cash positive.
Oh, very interesting.
Right? And at that 80 rupees, the market was telling me, 80 rupees a share, the market was telling me this company is going bankrupt.
Correct.
So I said, okay, HCG is the largest oncology super specialty hospital chain in India. Number 2, India is the fastest growing cancer market.
Correct.
Number 3, if HCG were to go bankrupt, can this asset be replaced soon? The answer is no. With so many doctors, nurses, infra, hospital chains you can't replace like in a matter of years. It will take you decades to replace a hospital chain. So it's a critical asset for the Indian infrastructure, healthcare infrastructure standpoint. And number 4, if I were to talk to, let's say, other hospitals like Apollo, Fortis, who are also venturing into oncology, not in a super specialty fashion, but within their hospital setups, they're investing a lot in oncology, trying to scale up that division. They said it's very difficult to scale up. And it's difficult because you don't get the right doctors, you don't get the right technology, you don't get this, that, and the other. So there was a lot of entry barrier in the business, which taught me that this business cannot go bankrupt. That was the call. That bankruptcy to nahi hoga. Yes, जब तक COVID होगा तब तक margins will suffer, top line will suffer, cash flow is still positive, so debt is not piling up. And these guys will survive COVID and then they will shine. So we took on that bet at 80 rupees in HCG. After we bought the stock at 80 rupees, stock price went to I think 90 rupees. And then CVC Capital, a private equity firm, bought HCG majority stake at 130 rupees when the market price was 90 rupees, which meant they gave a 50% premium to the stock price.
Wow.
Which was available in the marketplace.
Good signal.
Because they wanted a controlling stake in the business, which was a great signal. So we increased our exposure to HCG.
Interesting.
And CVC just exited. KKR bought it from CVC. Today, I think HCG stock was 750 or whatever. So, we have made our almost 9x on the stock in 5 years. Again, patience, because when we bought it during COVID, we did not know whether that 80 will go to 60 or not. We did not know if COVID will be 2 years or 5 years. We did not know this. So it was a call that COVID will go on for as long as it has to go. But after COVID, this guy will shine.
Beautiful.
Because cancer is the largest, fastest growing disease in India.
Beautiful insight on
So patience helps us identify such opportunities, I think, which aren't commonly sort of, talked about.
And something that went wrong?
Yeah. I mean, for us, a stock went wrong where, so I'm not going to name the company because it doesn't suit it. The fact is that the company was developing a novel molecule. Now, novel molecule development generally tends to be a risky business because the approval rate in the world is 3%. From preclinics to commercial approval, the stages of development are different. But eventually, if you look at how many preclinical molecules make it to a commercial market, it is only 3%.
Okay.
So if there are 100 molecules in preclinical, 3 of them will make it to the market. Now, this guy was developing this molecule aggressively. He was putting a lot of money. And he was already debt-laden because his businesses were not doing that well. He had a US generic business where he had invested a lot. And then he had US FDA trouble. So he was not able to sell. So the debt was piling up.
Oh.
Despite debt piling up, his passion made him invest in this novel molecule a lot. And his cash flows were weak, negative cash flow and all that. we took a call that this guy has an India business, which was good. So that good quality brands, household brands, good growth rate, amazing margins. So we said, we use the same template of IPCA. We said, if the guy is sane, he's not going to continue his loss-making business and he will scale it down, right? Or make it profitable, either ways. And then eventually, the stock price will do well. So we bought the stock thinking that. We waited on the stock for a year at least. Then this guy went ahead and sold his India business to finance his novel molecule and his export business, which was bleeding.
Oh my God, okay.
So when you do that, then you have actually sold the cash generating business to finance the cash guzzling business. And we had hoped for the opposite.
Correct.
That you would sell or scrap your cash burning business to save your cash flow of the cash generating business. But this guy did the opposite. And then we lost money in that stock. So we sold it.
Yeah.
After the day he sold his India business, we sold the stock. They said, look, this guy is going in the exact opposite direction.
So your exits are usually determined on the thesis not playing out?
Yeah.
Versus, let's say, a stop loss or like a
we don't have
drawdown.
stop losses per se. What we do have is, so we churn the portfolio on two reasons. Number one, as I said, if the thesis is violated, we sell. Profit or loss, we don't look at it. We just sell. Number two, let's say when I bought a stock at 100 rupees today, with the perspective that in 3 years the stock will be 300 rupees, let's say, hypothetically. And let's say in 6 months the stock goes to 250 for no visible change in fundamentals, not visible to us at least. Then we have made the majority of the 3-year return in the near 6 months, right? So, and then maybe another 50 rupees of return, which is another 20% of return is left, but over 2.5 years.
So risk reward is off.
So risk reward is off now. So hence, then we sell the stock. We say, look, let's take the money out and let's put it somewhere where today again that stock price is 100 and in 3 years we expect it to be 200 or 300. That is where you invest.
And do you stagger the exit or do you exit full? Because some retail investors will keep little bit ki wo 50 rupees bhi hum capture karenge.
Nahi. So it depends. So if the thesis is violated, it's a complete exit. There is no staggering.
Okay.
Because there's no logic to now holding back to a single share. If we are selling because of this, 100 becoming 250 and then later we had thought of 300, then we might stagger it a little because you want to sort of not pressurize the stock just by selling yourself.
Yeah.
And you want to slowly, smoothly exit. So yeah, it's a combination.
Interesting. No, I'm asking these questions because from a retail standpoint, in portfolio management, all of these questions come in our heads as well, right? We don't know the future. Yeah. But I love the way you've broken down a lot of these things. Now, apart from healthcare, because I know you love healthcare,
sure.
2 sectors that you think in India will do well.
So I think at this point where we are putting a lot of capital to work is one on the NBFC, MFI and PSU bank side.
Interesting space.
Yeah, very interesting. So what has happened again, it's the same framework. So this framework I call paid to wait.
Paid to wait.
Paid to wait. So I should be paid to wait. I'm okay to wait, but I should be paid to do so.
Yeah.
Right. So what is happening right now is in the last 1.5 years, if you look at RBI, they have put a lot of credit controls on NBFC, MFIs, risk weights have gone up. They've done different things to limit their ability to lend and to make them more judicious in how they recognize NPAs and all that. That basically has resulted in higher provisioning and lower profits, in fact losses also sometimes for most of these NBFC, MFI institutions. But if you think about this business critically and if you think about the sovereignty of India and how this space will eventually evolve. Now the reason why NBFCs, MFIs exist is because banks cannot reach these people.
Correct.
So you should look at NBFC, MFIs as retailers of the bank's capital.
Correct.
Now these are retailers of the bank's capital, right? And they reach the audience which banks cannot reach. And HDFC and Axis and ICICI will not be able to reach. These guys are able to reach. Now, if you're talking about India's sovereignty, if you want to avoid a civil revolution in this country, these people whom NBFC, MFIs lend to, you have to ensure they have access to capital. So if you're RBI, you cannot shut these people off, their credit lines off. You have to keep the credit line on. These are your farmers, your daily laborers, your rural India, your tier 3, tier 4, right? So this business is going to survive. This business does not have a problem of mortality. So that's point one. Point two, obviously the macroeconomic situation, RBI's regulations, all that has tightened the norms because RBI fears a systemic event or whatever.
Correct.
So that is fine. So that is causing near-term issues in the P&L balance sheet of these companies. But overall, as the economy progresses, that tap will again have to flow.
Correct.
These guys need credit and they will be needed to be given access to credit. And hence the NBFC MFI space will have to revive. And if that happens, then you have your NIMs and then you have your asset quality and then you finally have your PATs. So if you look at their historical average ROEs, right, they have been around 12%, 13%. And today if you see they are reporting -2, -5. So it's a cyclical bottom of your ROE.
Correct.
If you look at their historical average trading multiples price to book, it is between 2 to 8 times if you count Bajaj Finance. It
Yes.
is 2 if you remove Bajaj Finance, one extraordinary outlier, then it is between 2 to 5 times price to book. And most of these NBFCs today are available at 1 time, 1.2
Yes.
time, 1.5 time price to book. Some of them 2 time price to book. So they are basically 30-40% cheaper compared to their own historical averages.
Wow.
So now think of it. Earnings is at a bottom. Multiples are at a bottom. If there is a revival, earnings go up, multiples go up. As a shareholder, that's a double bonanza for you.
Yeah.
Your stock prices go up because earnings have gone up. Your stock prices also go up because multiples have gone up. You make extraordinary returns.
Huge re-rating happens.
So that's why we like the NBFC MFI space. And the other space related to this is the PSU banks. Now, PSU banks, so it's a call that we have taken, driven by data. Since last 5 years, post-COVID, PSU banks have structurally changed how they function. So earlier, if you look at, again, 10-15 year data, PSU banks credit growth 3 to 5%. PSU banks NPAs 4 to 6%. PSU banks ROEs -4 to +4%. That's the broad range PSU banks used to do. And private banks were obviously trading much, higher because private banks numbers were different. They were doing 13-14% credit growth.
Yeah.
Their NPAs were less than 1%. Their ROEs were 13-15%. And hence they were trading at 4 times to book, 3 times price to book. Whereas these PSU banks used to be 0.6, 0.7, 0.8, 0.2 times also sometimes price to book. If you look at the last 4 year data now, PSU banks loan growth is similar to private banks.
Correct.
Their asset quality is better than private banks, and their ROEs are coming close to private banks.
That's why we see the PSU rally much more than the private rally there.
We have seen that over the past couple
In the
of years.
past few years, yeah.
But even now, most PSU banks are trading at the upper end of their historical valuation range.
Correct.
So if the historical valuation range is 0.5 to 1 time price to book, most of these PSU banks have reached 1 time price to book. But that range is no longer valid. It is not. Because that range existed when the ROEs were different, the NPAs were different, the loan growth was different. Now all these parameters, operational parameters have shifted.
Interesting.
So unless you fear a reversion to those kind of performance on operational metrics, which, in my view should not happen because there's a structural change in how these banks are operating,
Yeah.
then those
Beautiful.
valuation bands are not relevant.
Beautiful.
So we have a very interesting saying. One thing we learn from history is that we don't learn from history,
Yeah.
right? That's for mankind.
Yeah.
Mankind has never learned from history.
Yeah.
So we don't want to make that mistake. Private banks at one time had these kind of multiples.
Yeah.
0.6, 1 time. Well, that was 20 years back. Private banks were trading at these kind of multiples. Then private banks improved operating performance, multiple re-rating followed. It is basically the same call we are taking. Now the PSU banks have that added risk of a farm loan waiver or priority sector lending where asset quality might be slightly weaker. But even if you discount for those, the gap that exists today where private banks are 3 times price to book and PSU banks are 1 time with similar operating metrics, that gap has to narrow.
Yeah.
You cannot have a 200% premium on private banks anymore.
Superb. Wow, it's very, very deep and very insightful, honestly. I mean, as a retail investor or as someone who looks at the market, I don't think many people think from a different standpoint. I think your style of thinking is very different.
I mean, it comes from patience,
That's
honestly.
what, yeah. Patience and experience also. I think that is 2 things that I've observed from this meeting that we've had.
Yeah.
Awesome. Now let's go into a lighter segment, the last segment. I call it like a rapid fire round. I'll ask you some questions and let's try to answer it in like a minute or so. Okay. Yeah. First thing is, can you name 2 or 3 books that really hit you when you were learning?
So I'm very infamous for saying that I have not read too many books. I realized probably way early from my school days that reading books is okay.
Yeah.
But unless you implement them, they're not that helpful.
Okay.
They're actually somewhat, you're wasting your time.
Yeah.
So you would rather read fewer books and implement what you learned. I think that makes a bigger success. Beautiful. So for me, the 2-3 books that really hit me hard, one is Psychology of Money, Morgan Housel, Joys of Compounding, Gautam Baid, and Rich Dad Poor Dad.
Beautiful.
So I think these are 3 books which I have not only read, but I try to implement the learnings in the way I live my
real
life.
Wow, wonderful, wonderful. Now, coming to another question. If you had a framework to distinguish between good, bad and ugly companies in quick terms, what would that be?
So a good, bad and ugly. So a good company would be a company with somewhat secular top line growth, somewhat secular cash flow growth, and a management which is honest and aligned with the minority shareholder.
Okay.
So that's a good company. A bad company, growth might be slightly volatile, but the management's intention are very pure, right? They want to grow the business. They're just in a segment where growth is just not secular, right? Which can be your autos, which can be your banks, because these are macroeconomically sensitive, businesses. They will have a lot of bad companies, but maybe not so many good companies because they will have some cyclicality in their earnings all the time. So that to me is a quote unquote bad company. And ugly companies where the management's intention is to loot.
Yeah.
Is just to fool shareholders and to make money for themselves. As I said, they reverse calculate their compensation
From the PBT.
From the PBT. They have royalties for the brand that they own the brand. The company is doing the business, but they own the brand and the company pays them royalty for running the business. So all kind of things we have seen in the past. So those are ugly businesses.
Okay. And do you think will India be able to overtake China in the healthcare sector?
So look, it depends on what vantage point you take. So if you're looking at the market size, China today is about $200 billion. We are about $50 billion. And the reason is not the volumes. The reason is the pricing at which China, prices its healthcare services. They are much more expensive than us.
Okay.
So it's broadly the pricing which creates that gap between India's healthcare and China's healthcare. So in terms of market size, we'll never be able to achieve China because China is expensive compared to India, which is far more affordable in terms of healthcare. So we'll not be able to reach there. In terms of capabilities, so you divide healthcare into three parts. There's healthcare services, there is pharma. Within pharma, there is large molecule and small molecule. Healthcare services, we are already better than China. No doubt about it.
Beautiful.
India is the largest medical tourist hub of the world. True. Right? So all medical tourists across the world come back to India for their tests and for their surgeries. So we have already beaten China in healthcare services. Within pharma now, if you look at small molecule and large molecule, small molecule is your chemical drugs, large molecule biologic drugs. Small molecule, we are almost neck to neck with China. They are better than us in the raw material segment. We are better than them in the finished goods segment. So they provide the raw material, we provide the finished good. That's the equation in the small molecule. In the large molecule, they are way ahead of us. And I don't think we'll be able to catch up in the next 2 decades also. They are doing far more fascinating work. So China basically skipped the small molecule value chain completely. They had the raw material and then they straight away jumped to the large molecule. And in between everything India does. Beautiful. So that way they are, complementing each other. They're not really competing that much. Yeah. And I think that chemistry works because we buy the raw material from them, we send them the finished good. So, China cannot weaponize its ability to sell the raw materials because they won't get the finished goods otherwise.
Beautiful. And one very interesting question, okay? Like how in hospitality space, Tatas are very well known for their management and how they treat people. Yeah. In the hospital space, who do you think is the Tata of the hospital space? Oh, wow. Good management, good service, never compromises on things like that.
So look, I can talk about the listed players. Obviously, unlisted, there are very, so even Tatas are there in the unlisted space in hospitals. And, purest of intentions. Yeah. Service might be slightly on the lower end because they don't charge you. So Tata hospitals are generally more charitable hospitals. So services are reasonable given that they're charitable. But on the listed space, I would say, if you look at a price, right? So now, let's just do some math. So there is a very large hospital chain listed. Their ARPOB is average revenue per bed per day. So their ARPOB is touching around 1 lakh rupees. And
1 lakh?
1 lakh rupees. Okay. And they do everything under the sun, which includes maternity, gastro, oncology, cardiac, everything. And HCG, which does only oncology, which is the most expensive of all these sciences, they report about 45,000 ARPOB. And HCG is a super specialist. So they presumably give you the best quality of service and best quality of tech that you need in the space. Now, when you compare the two, you would say HCG is far more affordable, probably better tech. This guy, when you walk in their facilities, it feels like a 7-star. So if you can afford the 7-star, why not spend on the 7-star? Yeah. That kind of a facility, right? So there is no one name. It is so each of these companies, they have their own niches, their own target audience, and hence they cater to that. So it's your paying ability which determines what you want to do and your thought process. So if you're a cancer patient, you can walk into this large hospital which will charge you. So the large hospital has an average ARPOB of 1 lakh. So I'm assuming their cancer ARPOB will be 1,50,000 or 2 lakhs, right? Wow. So you can go there if you want, and you can pay that if you want, or you can come to an HCG, which is 45,000-50,000, let's say, whatever, and you'll get the better treatment or better tech at least, if not the 7-star facility, but you'll get the better treatment.
And do you think premiumization is happening in hospitals as well?
Absolutely, it is happening. So this large chain that I spoke of, they are the premiumization leaders in the space. So when you walk into their facility, it's a 7-star. Wow. It is a 7-star, but it hits your pocket, so it's your call. If you can afford it, take it. Why not?
Wonderful. So I think, sir, that's it. I think I've asked most of the questions. But again, sir, I really loved this entire podcast, mainly because I think from the journey you spoke of how you got into Glenmark to where you are today, running one of the best healthcare funds in India, is truly remarkable. And I think the knowledge that we got today was unparalleled, right? I don't think, as you said, any book. This is why I love doing podcasts. I just like to listen to somebody, and I could listen to you for hours. So again, thanks a lot, sir, for coming and giving this knowledge to us, so that all of our retail audience could also hear this.
Thanks, Shashank.
Again, thanks a lot, sir.